It's simply put, when fear sets in and change happens, it's a great time to make moves. And in good times, when interest rates are low, real estate investors make money. In bad times, when interest rates are high, the best real estate investors acquire great assets. Things are continuing to change for the worse in the real estate business. I'm going to give you an update in this podcast episode. I'm also going to tell you about where I am, what we're working on, and how we think about it all. I've been looking at houses in my town on Zillow, as you probably do as well. And it's a great indicator of where the market is. The housing market always leads. It always is dependent on interest rates. And when houses stop selling, you have reason to be nervous, scared, whatever it might be. And houses in my town are simply not selling. They're not selling really anywhere. I'm seeing many houses that were bought last July through the fall into the very beginning of 2022. They were acquired by a flipper, maybe for $350,000. Now they're listed for $550,000. And 20 days ago, they were listed for $590,000. 20 days before that, they were listed for $625,000. A month before that, they were listed for $700,000. The prices are dropping on virtually every house that's listed in my town. I don't know very many that are trading at all. Mortgage volume is down anywhere from 40 to 90%, depending on what source you're looking at. In the commercial real estate business, every investor that I'm talking to is pencils down right now on new acquisitions. My buddy who builds self-storage facilities has stopped all new development. Industrial guys are slowing way down. Apartment buyers and builders are pencils down. Any developer that's not pot committed on a deal, meaning they have hard money or they're under construction right now, they're going pencils down, meaning they're stopping everything. Basically, everybody I talk to is locking up and nothing is really transacting. Self-storage brokers are listing stuff for sale that's just simply not selling. And we're in a holding pattern right now. Last year, we acquired at Bolt Storage, we acquired $50 million worth of self-storage. We had a really big year. As you know, it's been a much slower year for us this year, but just how slow is quite incredible. Over the last 3 months, 90 days, we found just one deal worth $1.85 million. Let me put that in perspective. Over a 3-month period last year, we bought $40 million of storage. The last 4 months of last year, we bought $40 million worth of storage. This year, basically, we're going to do the last 4 months of 2022 with one deal acquired, $1.85 million. We continue to underwrite and analyze deals. Our acquisitions folks are calling. We're underwriting deals from brokers, but absolutely nothing is penciling, nothing is making sense, and we're not even close on price yet. Sellers, the people who are listing self-storage, they haven't been willing to come to the market. They haven't been willing to meet the market. They're not willing to sell their assets for what buyers are currently willing to buy it for, and it makes perfect sense. If you don't need to sell right now, why the heck would you? Prices have just dropped anywhere from 10 to 20 to 50%. We don't even really know. And this is all really triggered by the fact that interest rates have gone from 3.5% to 7.5% in a matter of 9 to 12 months here. So you cannot pay nearly as much when you're borrowing at 7.5%. You need way more cash flow to cover the debt, and thus you can't really afford to pay the same for the same property as you could a year ago. The big new development inside of our business is that we're beginning to see the first signs of operational weakness in the self-storage business. In October, new rentals, they were down anywhere from 20 to 30% across our portfolio. Our occupancy is dropping slightly, and it's also the case for other operators, other self-storage facilities, and other people inside of our business, and I track the REITs. The REITs occupancy is down 2% year over year, 1% month over month. That's significant. That means we're having net, loss of customers, more move-outs than move-ins. Some of this is seasonal. The fall is the slowest time for storage, but much of it is the fact that household formation, meaning they're not people buying houses and moving into new homes, is at a virtual standstill. So all the people who were renting storage units as they moved and went across town, as I'm sure local moving companies are seeing a tremendous crush, a drop down, an evaporation of local moves. So yeah, we begin to cut asking rates across our portfolio. We're dropping the price that we're asking for storage units, meaning a 10 by 10 storage unit, maybe it was renting for $105 6 months ago. Maybe we're listing it right now at $75. Maybe we're running promotions. We've dropped rents at 40 of our 59 properties. Some of these facilities, we've dropped rents as much as 40 or 50% to spur new move-ins. We're continuing to drive revenue. We're continuing to raise rents on current tenants. We're not stopping that. And overall, our portfolio is in a really good spot. We analyze it all the time. As you know, we fixed all of our debt, meaning we no longer have variable interest rates. We're relatively low leverage. Our debt yield is north of 12% across our portfolio. And net operating income, which means profit, it's still up 15 to 25% across our portfolio versus this same time last year. We have very few loan maturities within the next 24 months, and we're about to close our big one, a big refinance at one of our, it's going to be a $25 million new debt swig across our portfolio. Or no, $25 million value, about a $12 to $15 million debt swig. We're in a great spot to weather the storm, but what does this mean for you? And, it's simply put, when fear sets in and change happens, it's a great time to make moves. And in good times, when interest rates are low, real estate investors make money. In bad times, when interest rates are high, the best real estate investors acquire great assets. So our plan, as this all unfolds, is to acquire as many great assets as we can. We know we're not going to make money. We know we're not going to have big refinances or big sales and make money by the, hands over fist by the millions. But we know that self-storage is a game of boom and bust. It's slow, it's fast. You never know what it's going to be. And it's cyclical. We struck when the iron was hot last year. We bought a lot of storage. We had a lot of great assets under management right now. And we bought some great ones at the beginning of 2022. But it's been really slow, and that's fine. In the real estate business, I compare it to hunting. I do this analogy a lot. Sometimes you land on a rock. Imagine you're a lion. Sometimes you land on a rock. Most days you land on a rock. And sometimes, for a small period of time, you get off that rock and you go out in the field and you chase down a gazelle. You chase it down to kill it. You're out in the field, you're running down a gazelle. You kill that gazelle and you take that meat back to your rock and you lay back down and you wait again. Real estate is very similar. You make money in sprints. Sometimes it's just wise to not do much. So I can sense that the opportunities to buy distressed self-storage and real estate of all kinds, if you're listening to this, I can sense that these opportunities are right around the corner. So what we're doing inside of our business is that we're preparing for that. We're working on our management. We are fine-tuning the way that we do business. We're doing a big data analytics project around our revenue management. We are making a few hires. We are training a few folks. We are changing some things about our software. We're excited about an expansion, a construction arm of our company that we're investing in and developing. But the industry is changing. I mean, we're seeing more and more listings in the self-storage business with occupancy between 50 and 60%, maybe 65, 70%. And these assets were acquired less than 5 years ago by the person who owns it now. They bought it, they've struggled to lease it, and now they're trying to sell it. And they're trying to sell it at what they know is not the top of the market. The assets aren't trading. It's only going to get worse for these operators as they struggle this winter. They're going to lose more and more money. Who knows what they're going to do or when they'll be forced to sell. The opportunities aren't here right now yet, in my opinion. But just to put it in perspective, you're seeing some of these assets that aren't leased. You never saw self-storage assets being listed for sale at 50 or 60% occupancy last year. You just didn't see it. If you weren't 90% occupancy, you did not know what you were doing this time last year. This year's a different story. We're seeing a lot of self-storage facilities that are not leased up. That's interesting. So in my opinion, the opportunities aren't here yet. We're focusing on our operations. We're sharpening our iron. We're waiting for things to change. We're laying on the rock. But if you are listening to this and you have been trying to get in the real estate game for some time, you've been thinking about it, you've been talking about it, you've been saving your money, you've been reaching out to owners, whatever it might be, you should be excited. You should be working extra hard to underwrite deals. You should be working to build relationships with brokers and owners. Your time to shine is right around the corner. So that is what this is all about. It's changing fast. And I know that over the next 3 to 6 months, there's going to be tremendous opportunity in the real estate business. Maybe not an opportunity to make a bunch of money, but an opportunity to acquire great assets. Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single-family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.